Hi, welcome to Fidelity Soundbites. My name's Paul Taylor. I'm Head of Investments for Fidelity in Australia, as well as the Portfolio Manager for the Fidelity Australian Equities Fund. And with me today, I have James Abela. James is the Portfolio Manager for the Australian Future Leaders Fund. This is our first ever bonus episode, so we're quite excited. James and I have been together for a long time, so it's a good way to combine our knowledge on reporting, on the February reporting season as well. So, James, big overview. How did you see reporting season?
Sure. I think, look, Meetings Forecast was pretty mixed. The good stocks that you thought would do pretty well did do quite well. They delivered good results, confident. And the ones that weren't great was very disappointing. There were stocks that were down a lot of shocks in consumer, and then specific ones more like Domino's or Downer. But the pressures are all there now, inflation, interest rates, but confidence is not high. So it was very, very mixed, and I think that's the results. There are a few really positive sectors, which was really great, which was good to see. So definitely like financials was really strong. COVID recoveries was really strong. And also the tech facing the US was really strong as well. And then what you'd expect, the consumer was weak, etc. So that's really what we saw. And it didn't really confirm or deny, I guess, what people were looking for. It was very mixed, very stock specific. What about you in large caps? What did you see?
Yeah, look, I think it's quite similar. Broadly, I thought the actual reporting season was okay. There was probably still more downgrades than upgrades, and if you look at the market itself, so the ASX 200 was down, I think almost 2.5% for February. So that tells you something. Although I do think that wasn't just stocks; that was a bit of macro as well. So some of the macro we saw early in the year almost unwound in February. So maybe an expectation that, interest rates are going to go up a little bit higher, mainly in the US, and also, maybe China had run too hard. So a bit of reversal of what we saw early on. But I'd agree. I mean, I thought insurance, was a great result. I think that's a really positive sector, whether it's big cap or small cap. The banks did well, but, the question is can they keep going? Yeah, exactly. Can they keep going? The other sort of, consumers are a really interesting space, and I'm sure we'll have a chat about that as we go a little bit further, because consumers actually held in there relatively well to this point. And I just don't know whether this is a bit of a turning point. Interest rates have gone up. We're now, day after the RBA just took rates up to 3.6. And I think there's definitely more pain in the market now. So I think as we go through the year, we'll probably see more and more of that. So definitely the consumers in a tougher spot. So look, broadly okay. Some great sectors, insurance.
Staples was pretty strong.
Staples,
wasn't it?
You make a good point. Staples was good, and I think I always talk about essentials. So I think that's right. Some of the consumer staples showed their power. It showed their resilience in this market as well. So I mean, I guess following on from that, as we delve down deeper into the market. And you look at your portfolio, maybe what were you happy about? What were you positively surprised about, or maybe not even surprised, but just you're happy they delivered on your expectations?
Yeah, the great thing is the fund did quite well in the month of February. It was up, quite substantially relative, which was great, and it was really driven by the positive results. So, COVID recovery, so Flight Centre and Auckland Airport did well. The financials group, mainly in insurance brokers, did well. So that's Ausbrokers and Steadfast both did well. And then the tech names did well. So these are, Altium, WiseTech both did well, and also the fintech names such as NetWealth and Hub. So the stocks that we've been waiting for that are quality did well, but also the turnaround stocks, recovery stocks did well. So really, what I like to see is your quality and transition groups really did well. But for the fund, why it did so well is also value did quite well. So things like Ampol and Orica did well. And then stocks that we missed. So AMP was quite a weak result during the month. Whitehaven Coal was weak in the month. So there was a lot of things that were really working really well. So quality worked, transition worked, value worked, and things that we didn't own also worked. So underweights worked. So that was a bit of a symphony of good outcome, which is why the fund did quite well in February. And I was happy to see it because the market's been anticipating a lot of things over the last 3 to 6 months. And yeah, January was very positive. Small caps was up nearly 10% in January. So it had to give a bit back in February as reality started to hit, and the reality that we got in the stocks that we own was quite a good outcome. What about you and your...
Well, before I go into the one I was going to have a chat about was WiseTech, because that's a really interesting one to me, and it's actually one that we've owned. The interesting thing is one we've owned for a long time. It's been a fantastic stock for Fidelity, but it's one we actually bought pre-IPO as well. So that was an interesting proposition. Allowed us the opportunity to get to know the management team and the company a year before they even IPO'd in a very private phase. So I think that's a great one. And you and I have been together now almost 20 years as well. So it's one we've seen grow, over the long term. And they're the sort of stocks that have worked, those sort of compounders.
Yeah, beautiful
really
compounders you call them. I've seen it with Altium over 10 years. Stock was $4 and now it's $40. WiseTech, I actually bought it after the IPO, but it was $5, wasn't it, when it...
Something like that. Yeah, I can't remember now. Yeah.
These stocks that I call multi-baggers, or Peter Lynch called multi-baggers, that are up 10x over a decade, and that's what these stocks are. So we try and find high ROE, good, strong management teams, very good return profiles in, providing a service, I guess, for the community or for consumers that's very unique and well loved by their customer base, and that's why they are these beautiful compounders, and they just keep on growing and building. Adjacencies in the WiseTech example. So yeah, there's beautiful compounders, definitely something I think you and I have found and delivered a lot of alpha through those beautiful compounders over the decade.
Yeah, so for me, if I come back to the reporting season, probably the tough. I mean, if we talk about a couple of tougher ones, and then also ones that worked, because you always any reporting season, you always ones work, ones don't work. You're just trying to get more that work than don't work is the objective. But probably the ones that didn't work through reporting season, you touched on Domino's. Domino's is an interesting one because it has been a great stock for a long period of time. Fortunately, 2021 it did go. It had a significant run, and we took the opportunity through 2021 to lower our position, so that was fortunate. But we have owned it since then through 2022. It's been a tougher 2022 as sort of growth stocks have gone out of favour. But then just in the February results as well, they had a disappointing result, which was really, and they put it down to, as we see inflation, food inflation, wage inflation, as they've had to pay more. They initially took the hit to margin, but then decided to actually take the prices up to try to recoup some of that inflation. And I think they probably just took it a little bit too much. So they took prices up on the products, but they also added a delivery fee. And what they saw was actually still good demand for takeout, but what really got impacted was delivery. And, Domino's is a delivery specialist. They are, they'll get your pizza to you in 15 minutes, which is a fantastic advantage. But it meant that people were looking at the prices between takeout and delivery and going, well, actually, it's so much cheaper on takeout. I'll go and do that. So, but I think that's what they put it down to, and I would agree with that. But I think there's also maybe a little bit of normalization post COVID as well. So delivery went, really crazy through, off the charts through COVID. So there's a bit of normalization that's in that as well. But I guess as I sit back today, like I said, we've got a reduced position, which I was happy about, but. I think the longer-term structural trend of the digital delivery of food and beverage is still going to be with us for a long time. So I think there's still very good long-term structural growth in that sort of company. The other one that we have a very small position in, but the other one that had maybe gives an idea of broader trends was Downer. So capital goods has struggled a little bit. Once again through wage inflation, but also contract in sort of construction contracts in this environment or service contracts in this environment, just a little bit tougher as well. They've got some very specific issues. So they have had a difficult time. We haven't really done anything. We've just been sitting and watching it. Met with a new chief executive. He seemed reasonable and was part of the Spotless turnaround as well. So it's one to keep an eye on, and let's just see if they do what they say they're going to do. And I think, one to wait and watch and see what happens there as well. But on the positive side, very happy in some of our biggest positions, very happy with Suncorp. The insurance market is a real tight premium in the market at the moment. And I think Suncorp's the best. I think all the insurance sector, whether big or small,
they're all doing very well. They've got insurance hardening cycle, capital's coming out of the system, so the insurers are stepping into the system. They've got increased margin in tech reserves, increased margin on shareholder reserves, insurance margins are rising, volumes are up. So it's looking good for that whole universe.
The sectors looks great. On the big cap, I mean, Suncorp, I think, is the preferred because it's simplifying its business as well. It's doing a bit of its own restructuring. Ramsay Health Care I was really impressed with as well. So the private hospitals had a tough time through COVID. They're now coming out of that, and you can see the hospitals coming back to life in terms of some of the elective surgeries now as well. So that was a lot better. And as you touched on right at the start, supermarket. So Coles is a big position for us, and that they had a great result. I was really impressed with the Coles result as well. So yeah, look, mixed bag as always, but broadly okay.
And how are you feeling about 2023?
Yeah, look, I think so. The other way I've sort of looked at it is we'll have, from that result, because I think it's always very informative when I look at the reporting season. It just tells you, you're on track. I guess I'd look at my portfolio and think, I think a lot of what I'm thinking about for 2023 got reconfirmed in the results. So I've got a big exposure to essentials, which is those consumer staples, supermarkets, healthcare. I've got exposure to commodities, but it's focused on transition metals, so your nickel, copper, lithium. And I think that broad thematic of decarbonisation is a very metal-intensive phase of development. I think those guys are well placed in that. And then sort of cheaper sectors like insurance looks incredible for the year. So look, it's a bit of a defensive. It's probably a more defensive stance because of the exposure to essentials, but I'm actually still very confident and comfortable that that's the right portfolio positioning to have in what is going to be a slowing GDP, at least slowing. I still would probably say no recession in Australia, but that's debatable and that still could happen, but definitely slowing. And I think in that slowing environment, I'm very happy with that portfolio. I think it's one that's going to look after us through 2023. And yourself, how have you thought about your portfolio and how it's positioned and what could happen in 2023?
Didn't change much. Quality names in tech, quality names in really strong sort of cyclicals, right, where we're still holding. And then more, transition and value is where I'm comfortable. Only things like Orica and other ones which are delivering earnings and they've got growth. So I think wherever you are, you need to have growth and you need to have reasonable valuations. Also for me, the value, it's still quite defensive, the portfolio overall. So we still have a little bit of real estate, a fair bit of transition and value, which keeps it quite defensive. We don't have a lot of momentum, so I haven't really changed much in it. So similar to me, it really confirmed the positioning is right for this market, and I do think it's going to be quite a tough year, but there is still decent earnings growth in the market and in the portfolio, sort of that high single-digit growth is still there. Earnings didn't really change the view, but I'm very happy with the portfolio the way it is today.
Excellent, James. Thank you. It's great to do this bonus episode with you. And that is our wrap on the 2023 February reporting season. It was a really interesting one. I think we've covered off a range of those different topics. It has been great. As I said, our first ever bonus episode, 20 years with James. Good to talk through it. Now, if you have enjoyed the episode today, please subscribe to the Fidelity Soundbites podcast. And in fact, if you subscribe, we may even put out more bonus episodes as well. So ladies and gentlemen, thanks for joining today. Have a great day.
Some important information on today's podcast. This podcast is issued by Full Responsible Entity Australia Limited, AFSL number 409340. This podcast is intended as general information only and has been prepared without taking into account any person's objectives, financial situation, or needs. You should consider the product disclosure statement and target market determinations for Fidelity Australian products at fidelity.com.au. Please click the link in the show's description to read the full disclaimer.